Hello again, traders and investors. In this episode, we're diving deeper into the world of ETF or exchange-traded funds. We will focus on the practical implications of ETF and how they are created, redeemed, and traded. ETF are unique in the way they are created and redeemed through a process called in-kind creation redemption. Essentially, this means that instead of buying and selling their underlying assets in the open market, ETF create or redeem baskets of assets in exchange for shares in the ETF. Imagine you have a toy box which represents an ETF. The box is filled with different toys, like cars, dolls, and teddy bears, representing different assets in the ETF. Now, let's consider that you're a kid and you have exactly the same toys in the same quantities as in the toy box. Instead of swapping toys one by one, you can exchange all your toys at once for a toy box. The same applies if you have a toy box. You can give it away and get all the individual toys that were inside. This is just like an in-kind creation/redemption process in an ETF. You're swapping a whole set of assets, toys, for shares in the ETF, the toy box, or vice versa, instead of trading each asset individually. In this process, the role of authorized participants, or APs, is crucial. AP are usually large financial institutions that have the financial clout to buy those large baskets of securities. They create new ETF shares by buying up the assets the ETF wants to hold and then delivering them to the ETF provider in exchange for ETF shares. The reverse happens when they want to redeem ETF shares. Think of authorized participants as the big kids in the playground who have the means to buy and trade a lot of toys. When the big kids want a new toy box, they go out and gather all the right toys in the right amounts. They then bring these toys to the teacher who checks to see if they've got the right mix. If they do, they get a new toy box in return. The opposite happens when the big kids want to break up a toy box. They bring the toy box to the teacher, who opens it up and gives back the individual toys. In both cases, the big kids use their resources to gather or disperse a whole set of toys at once, rather than trading one toy at a time. This allows the ETF to efficiently manage its collection of assets. Now, let's talk about an ETF net asset value and its market price. The NAV is the total value of the ETF assets minus liabilities, divided by the number of shares outstanding, calculated at the end of each trading day. The market price is what the ETF shares are actually traded for on the exchange during the trading day. It's possible for these two prices to differ due to supply and demand dynamics in the market, resulting in what we call a premium or a discount to the NAV. One critical factor to consider when investing in ETF is the expense ratio. This is the annual fee charged by the fund manager to cover operational expenses. A high expense ratio can significantly reduce your return over time. ETF come in all shapes and sizes, providing exposure to different sectors and categories. For instance, US sector ETF like the Technology Select Sector SPDR fund that targets the tech sector, and thematic ETF like the Global X Cybersecurity ETF focusing on cybersecurity companies. Remember, knowledge is power in the world of investing. By understanding the inner workings of ETF, you can make more informed investment decisions. That wraps up our deep dive into ETF. Remember to like, share, and subscribe for more insights into the world of trading and investing. Happy trading!